Now, for more on investing opportunities in the cloud sector, let's bring in Byron Deeter, partner at Bessemer Venture Partners. Byron, good to see you again. So,
thanks, John. Happy holidays. Always great to be back.
Happy holidays. Yeah, today the WCLD touched 52-week highs. So how much more danger do some of these stocks, including SaaS stocks, face from the combination of a demand slowdown and subscription fatigue?
Well, we've been on defense for most of this year, as you've seen. WCLD was the top performing ETF on all of NASDAQ in 2021 and gave up 2/3 of those gains going into 22. And so, frankly, I think it overreacted both ways. This build back is what we see now as companies are starting to go back into growth mode. And there was this profits at all costs mindset that really dominated 23. These companies did cost rationalization with layoffs, with cost moves, et cetera. And now they're starting to think about growth again. And that's the excitement that's starting to build, is we think there's a chance to be back on the offense. And we're starting to see that as the growth rates come up and as the multiples are slowly starting to come up in anticipation of that.
And you argue that for late stage companies, and I guess this might apply in some cases to public companies as well, that overdoing it in the rule of 40, looking at free cash flow, really overlooks the fact that growth is 2 to 3 times more valuable. You favor the rule of X? Why?
Very much so. So we've actually tried to put a ratio around this, which people can search Bessemer rule of X online to get the long form. But the punchline is that even in high interest rate environments, growth is still more valuable than profits, because in subscription businesses, $1 that you invest today, if you get $1 back next year, you get it in each subsequent year. And so it compounds in a really powerful way. And in the height of this pullback, people were starting to value things at a 1-to-1 ratio, where literally they were so defensive and so fearful that they were starting to think of things as, give me the dollar now, and I don't care about any future profits. That's where we think that a number of companies, and including some of the leaders, but the Adobes, the Salesforces, the Cloudflares of the world, where people were really valuing that profit stream, had forgotten about the compounding effects of growth. And that's where in the rule of X, you see, even in these tight markets, about a 2.3x ratio should be applied for companies that are weighting growth over profitability. And for companies that are large with very low costs of capital and high predictability, they could invest at 3 or 4x in growth for 1% of growth at the expense of 1% of near-term, short-term free cash flow.
I'm curious what you think about how public market investors are valuing companies that are publicly traded, including some that have been in your portfolio and that you've invested in the past, like DocuSign, for which there are reports circulating that it could be open to potential acquisition. Do you think we are going to see more M&A, more potential take private because of how investors in the public markets are thinking about some of these tech names?
So with the cloud index trading on average at 6x, I think there's a lot of appetite for M&A. But frankly, the Adobe Figma news has sent a chilling effect through the industry, where there's this freeze on big tech M&A, which I think is really bad for the economy, and it's really bad for innovation. And so you're going to see this paralysis at the top, where big tech is really hesitant to make these moves. And that's going to have a ripple down effect to the economy for the smaller and the mid caps. We're hopeful that the IPO market opens up a bit next year, which creates the other outlet. But mathematically, the vast majority of private companies depend on M&A for their lifeblood and for their exit, which is how capital and talent unlocks to do it again downstream.
Byron, really, though? I mean, because Adobe Figma, I mean, I like to talk to Shantanu all the time, but Adobe is the poster child for big, giant, and design software. And Figma was like the one big enterprisey name that could challenge them. This was not a vertical merger by any stretch. Even after Microsoft got Activision and all the other things that have gone through, people are starting to make fun of Lina Khan at parties. You think this one's going to have a chilling effect?
So we're investors in Canva, which is a multiple of their size and an adjacent competitor. So the fact that the DOJ tied them up for over 15 months, froze it and blew it up, is a great net effect because it weakened a competitor. The recent report that came out yesterday said their growth rate fell to below or around 40%. So they're now a fraction of the size and growing much slower. And so from a competitive standpoint, that's great. They've weakened a competitor. From an innovation standpoint, from a fan of technology and from capitalism, I think that's a bad outcome. And it's going to absolutely stall M&A in the future, which then takes out at best the marginal bidder, so that you don't have the effect to truly find a clearing price. But at worst, it takes out the only bidder, and you stop getting unlocks for entrepreneurs, which then is necessary for them to start the next business and for talent to flow to the next idea. And they don't have other exits. And so you have this paralysis that absolutely has a negative effect on innovation, which then impacts job growth in the economy.